Before we begin, please support the channel by subscribing, liking, and sharing this video. Constructive discussion is always welcome, and we invite you to share your views and insights in the comments. Q1 Big Tech Earnings, CapEx, Free Cash Flow, and AI Outlook. This video presents a direct informational narration of the source document.
Okay, let's dive into this. We're going to walk through a sequential financial breakdown, starting with the macro environment, and then we'll look at the performance and forward outlook for 4 specific mega-cap equities.
Section 1, Market and Fed Overview. Let's set the stage with the broader macroeconomic context that's currently impacting the technology sector. Right now, we're seeing the Nasdaq really outperforming other indices. Reports are pointing to preparations for a long-term blockade on Iran, and that's actually pushed Brent crude oil above the $110 threshold. We can expect this elevated energy price to create a delayed negative economic impact over the next 3 to 4 months. On top of that, market breadth is notably narrow. It's really just the technology sector, driven by recent semiconductor advances, that is sitting at historic highs. This kind of distorts the S&P 500's overall trend, especially while other sectors are facing downward pressure. And looking at monetary policy, well, market bets for 2026 rate cuts have dropped all the way to zero, with even a slight probability of a rate hike creeping in. The Federal Reserve held rates steady. We saw one dovish member dissenting, pushing for a 25 basis point cut, but 3 officials actually opposed maintaining a dovish leaning. The Fed's statement also shifted its terminology, upgrading inflation to quote-unquote elevated, pinning that on global energy spikes. Finally, the Fed chairman noted he will remain a board governor until the U.S. Department of Justice wraps up its investigation. This points to some unresolved judicial matters, though he did clarify he won't be acting as a shadow chairman. Moving right along to Section 2, Meta, CapEx, and Free Cash Flow. Let's transition over to Meta's first quarter performance and their forward outlook. So Meta's Q1 results gave us a real mix of data. On both the top and bottom lines, the company beat expectations. Earnings per share came in at $10.44, which is a nice jump from $6.43 last year, and it definitely beat the $6.66 estimate. However, and this is a big caveat, it's really important to note that this $10.44 figure was heavily influenced by a Q1 tax adjustment anomaly. It doesn't represent a standard operational baseline. Revenue hit $56.31 billion, a 3% year-over-year increase, topping the $55.10 billion estimate. Looking ahead, their forward guidance for Q2 revenue is set between $58 billion and $61 billion, which lines up pretty closely with the $59.56 billion consensus. Total expenses are also projected to match expectations, sitting between $162 billion and $169 billion. Now, what's really interesting about this slide is Meta's decision to once again raise its capital expenditure forecast. Their full-year CapEx target has been bumped up to a massive range of $125 billion to $145 billion. This completely exceeds analyst estimates and marks a 7.4% increase from their previous $115 billion to $135 billion range. Management chalked this hike up to higher component prices and extra data center costs. To put that into perspective, at this aggressive pace, the company is going to be adding $10 billion in CapEx every single quarter. That signals some notably higher costs for Meta, but on the flip side, increased revenue pipelines for its hardware suppliers. Because of this huge CapEx surge, without a matching immediate bump in revenue, Meta's free cash flow is actually projected to turn negative by the end of 2026. Meta is actually the first of the 4 megacaps to signal this kind of negative free cash flow risk. If they can't swiftly convert this CapEx into AI monetization, the company might have to lean on debt financing, and as we know, that would inevitably drag down profitability and growth rates. To try and offset these massive expenditures, Meta has rolled out some pretty strict cost controls. This includes 8,000 recent layoffs and leaving 6,000 roles completely unfilled, all with the goal of saving $10 billion a year. Breaking down the forward valuation ranges based on historical multiples of 16.9 to 34.3 times, Meta's December 2026 forward range sits between $504 and $1,026, with a median of $765. Looking out a bit further, the 2027 forward range is $574 to $1,176, giving us a median of $877. We noted technical support levels at the $638 to $680 range, but that actually became resistance after a post-earnings drop. A stronger support level lies between $590 and $511. Analytically speaking, proximity to that $500 level presents a much more secure cost basis. But again, that's entirely contingent on the successful monetization of these AI investments by late 2026.
Let's move on to Section 3, Amazon, AWS, and spending. We'll shift strictly to Amazon's Q1 metrics and their infrastructure investments.
So, Amazon reported an EPS of $2.82, comfortably beating the $2.63 estimate. Net sales reached $181.52 billion against an expected $177.23 billion. Operating income was also strong at $23.85 billion, surpassing the $20.75 billion forecast. Notably, AWS net sales hit $37.59 billion, growing 28% year-over-year. Now, while that was just slightly below the 30% consensus, it still represents AWS's fastest growth rate since Q2 of 2022. The cloud segment's operating margin also saw a really nice improvement, rising from 35.03% up to 37.68%. As for Q2, net sales guidance is projected to be between $194 billion and $199 billion, which points to a solid 17.2% revenue growth rate.
So the crucial point is the state of Amazon's free cash flow. Their trailing 12-month free cash flow has taken a sharp dive down to just $1.2 billion. That is a drastic drop from the $25.9 billion recorded during the same period last year. This puts Amazon at a critical threshold. They're risking a shift into negative territory, very similar to Meta, if they don't strictly manage their capital expenditures against incoming revenue growth. Speaking of those capital expenditures, management has maintained their full-year target of $200 billion. That's a 56% year-over-year increase, and it's primarily being poured into custom AI data centers. It's really worth pointing out that Amazon is the only company among our 4 megacaps that did not raise its 2026 CapEx target during this reporting cycle. That being said, Q1 CapEx already hit $44.2 billion, which suggests that if they want to stick to that $200 billion target, their spending in the upcoming quarters is going to have to decrease. On the valuation side, the December 2026 forward midpoint sits at $212, while the 2027 midpoint is $256. Section 4, Google and the Cloud Backlog Surge. Next up, we're examining Google's highly positive earnings data and their cloud execution. Google's Q1 report really demonstrated some robust outperformance. Their EPS came in at $5.11, significantly exceeding both the $2.63 estimate and the previous year's $2.81. Quarterly revenue hit $110 billion, beating the $107 billion expectation and reflecting a 22% year-over-year growth. Cloud sales reached $20 billion, up 63% year-over-year, and boasting a 33% operating margin. On top of that, search volume actually reached an all-time high in Q1 of 2026, and while they didn't specifically disclose Q1 monthly active users for their Gemini chatbot, they did note that paid subscriptions have now hit the 100 million mark. And this brilliantly illustrates a major catalyst for Google. Their cloud backlog nearly doubled, jumping from $240 billion in the December quarter all the way to $460 billion in Q1. This massive increase represents tangible AI workloads. We're talking model training and processing that are literally just waiting for data center capacity so they can convert into actual revenue. This strongly confirms that rapid AI monetization is already well underway for the company. To tackle this immense backlog, Google has significantly raised its full-year CapEx forecast to a range of $180 billion to $190 billion, up from their previous $175 billion to $185 billion estimate. First quarter CapEx came in slightly below estimates at $35.67 billion, but you can expect that spending to accelerate. The CFO also mentioned that 2027 CapEx will substantially increase over 2026. Here's the thing. Because Google actually has this confirmed customer backlog, expanding their production capacity to meet this surging demand completely justifies the heavy investment. Now, contrasting this massive CapEx hike with their balance sheet, Google actually maintains the safest financial position among this group. Their free cash flow is holding perfectly steady at approximately $10 billion. Looking at valuation, the 2026 midpoint is $288, and the 2027 midpoint is $334. So when you factor in the strong backlog and the potential for upward EPS revisions as their production capacity finally meets demand, Google presents a highly stable financial profile paired with crystal clear revenue visibility. Section 5, Microsoft, steady yet spending. Let's move to and see how this builds as we evaluate Microsoft's fiscal Q3 figures and infrastructure outlook. Microsoft reported fiscal Q3 revenue of $82.89 billion, beating the $80.46 billion estimate, alongside an EPS of $4.27, which topped the $4.07 forecast. Azure and other cloud services revenue grew by 39% in constant currency, slightly edging out the 38.2% expectation. Looking ahead to Q4, total revenue is guided between $86.7 billion and $87.8 billion. The midpoint of that range is actually a slight miss compared to Wall Street expectations of $87.6 billion.
While their Q3 CapEx came in a bit lower than expected at $31.9 billion, Microsoft revealed a massive full-year CapEx target hike to $190 billion. That vastly exceeds the initial Street estimate of $160 billion. Spending is expected to really accelerate, crossing $40 billion in Q4 as unused allocations roll over. Obviously, this scale of investment is going to require absolutely seamless execution to convert into revenue.
Examining the balance sheet, we can see Microsoft's free cash flow has dropped 22%, down to $15.8 billion. Now, while the overall financial position is still relatively healthy, adding $30 billion to the CapEx budget directly impacts future cash flows. If that $190 billion CapEx can't be successfully monetized by the June 2026 fiscal timeline, there is a distinct risk of free cash flow depletion. For valuation, the June 2026 forward midpoint sits at $470, and the June 2027 midpoint is $517.
Section 6. AI Narrative and Semiconductors. Finally, we're going to tie these mega-cap CapEx spending profiles back into a broader synthesis of the semiconductor industry. The fundamental tailwind driving the semiconductor space right now is this continued CapEx expansion. The market consensus is projecting a 19% year-over-year CapEx growth in 2027 across these major tech firms. This directly benefits hardware providers like NVIDIA and TSMC, especially since 3 of the 4 major tech companies we analyzed today just significantly raised their CapEx outlooks. Looking at it from a technical perspective, AMD continues to maintain breakout support above $348. This sustained level of enterprise spending really validates the continuation of the broader 2026 AI narrative. And that brings us to the absolute core tension identified in our source document. Will this unprecedented mega-cap AI CapEx fully monetize by late 2026, or will accelerating free cash flow burn trigger a fundamental sector revaluation? The answers to that question are going to dictate market breadth and capital allocation in the quarters to come.